All right, quick question, Matt, before we kick off. If somebody walked up to you this week and said, should I be worried about my money right now? What do you tell them?
Being worried is always fine, but panic is very expensive and hard to recover
Yeah, that's a good point. It's interesting.
I mean, it's been a rough week, and you're in the market long enough, you'll have plenty of rough weeks, plenty of negative news out there. Oil's spiking, market's down, wars and rumors of wars. It's uncomfortable, but the people who make the worst financial decisions generally are usually the ones that let their emotions run the show, which is why you look at a chart of your favorite index. Ours would be the equal weight S&P, but you can also look at the Dow, the NASDAQ, the market weight S&P, look over a 20-year time frame and put your finger on that chart and tell me a bad time it was to enter the market.
Yeah, I'll also add there's a difference between being calm, sort of about the long-term direction, and being concerned about short-term. Both are very legitimate ways to look at things. Both can be true at the same time.
Yeah, absolutely. Very, very fair point. Welcome to Good Returns.
Welcome. Cheers.
Yeah, the show where we break down what's happening in markets and economy and translate it into something actually useful for your financial life, for your emotional well-being. I'm Matt.
And I'm Garrett. Thanks for joining us. We will have a good show today. Whether you've been investing for decades or you just opened your first account recently, this is kind of an idea for us to explain headlines of the week in our weekly note, is what we call it, via email. This show, Good Returns, as you said, is the podcast version of that.
Yeah, absolutely. And we are licensed fiduciary financial advisors, but everything on Good Returns is for informational and educational purposes only. We may not be your financial advisor, so nothing we say is personalized advice for your specific situation. We are here to help you understand the landscape of investing and financial planning and how to navigate this very, very interesting and rewarding world that we are in. But always reach out to a trusted advisor. And if you don't have one, go to momentumwealth.us and we'll be more than happy to talk to you about your situation.
All right, let's get into it. The stock market, big question. How did the stock market do this week? I've got a short answer for you. Short answer is not great. Story behind the numbers, though, is interesting. It wasn't really a straight sell-off, kind of some optimism early on in the week, and just didn't hold up. And we're here Friday. Market is open. We're about noon Eastern time. We're down decently.
Well, walk us through that. What do you mean when you say started off positive, kind of sideways, net negative? Index prices were down relative to last week, but wasn't really a violent, volatile week. But kind of walk us through.
Yeah, well, earlier in the week, you had the White House specifically kind of signaling that they thought the conflict in the Middle East was going to be largely over. Oil dropped. You saw stocks rally. The S&P was up over 1% at one point. Then sort of reality set in. Tensions sort of escalated. Oil rebounded. And by Friday, which is where we are today, the whole sort of rally had been gone. And we're going to finish the S&P is going to finish down. It's hard to say. I mean, maybe 2% on the week, a little bit more. Let's see where we are right now. Is S&P down 0.75 point. So, I mean, it's, it is what it is at this point. That's just the narrative. We started off good and sort of ended down for the week.
Yeah. Which again, whether you're investing in your 401k, in your brokerage account with your financial advisor, and you've been doing it for anything longer than really 12 to 18 months, it is a very, very common experience. But these short-term moves can play mind games with you, and they can become very important emotionally because it can lead you to make very bad decisions. And that's why you have to always keep a long-term perspective. You want to partner with professionals that pay attention to short, mid, and long-term moves and structural changes in the market. But you do not want to become emotional and react to every news headline, because if you follow this stuff long enough, you will come to learn one thing very quickly, is that the headlines and the knock-on effects are never what you think they are. They are never what you think they are. It's generally the second and third order effects that are what really become very interesting and impactful as any situation evolves. Think no further than COVID and what occurred in the markets during that period of time. First of all, before you would even consider thinking about what happened to the stock market, It would not have been on my bingo card to think that the immediate effect of lockdowns would be the absolute destruction of the toilet paper inventory at the grocery stores. It just would not.
Well, that always happens during any kind of
minds. I know, but at the scale and level was, it's like, food is important, medicine. Toilet paper, you can figure out ways to live without it if you had to, but it's just when you start taking that, then you see, and then also the effect of being cooped up, and the rebound that occurred, and then the structural changes on where people lived. I don't think you could have necessarily predicted exactly how that would have played out, but when you look long term, you see structural changes that still stick, that add efficiency, such as virtual interactions, the ability for people to move kind of anywhere they want to, lower their cost of living, increase their quality of life. And that's really a permanent structural change that's going to stick with us for this generation. But let's talk in reference about the S&P being down. I don't know, did I get on a rabbit trail?
A little bit, but it's okay.
It's fine.
S&P is down like 4.5, maybe a little under 4.5 year to date.
And so when we talk about the S&P, that's the market weighted S&P. Let's remind everyone what we're talking about.
Yeah, so the S&P 500 is a basket of 500 stocks. It's not exactly 500 stocks, but that's the easiest way to explain it. It's a little more than 500. Think Apple, think JP Morgan, things like ExxonMobil. You got hundreds of others in there. It's the most widely used benchmark in the U.S. for when somebody says the stock market was up today or the stock market was down today. They're usually talking about the S&P. It covers about 80% of the total value of U.S. publicly traded stocks, and it's a pretty good representative. We always talk about the equal weight S&P, or really the Russell 3000, which we consider to be sort of the market as a whole, is what we're using internally when we talk with clients about performance metrics and things like that. That's what we tend to use, because the S&P, you can kind of get, like we've talked about the last few shows, you can kind of get to a point where that's kind of skewed, because if you see the market weighted version of the S&P 500 or the equal weighted rather, because the regular S&P 500 is market weighted, it's weighted by cap. So you have larger companies that are higher, more highly represented in that index. But the equal weight takes it and just kind of spreads it out equally amongst all the companies. Yeah. And when you see times like we've had over the past few weeks where it's sort of outperformed, then you can see in real time sort of a rotation happening there.
And rotation with the NASDAQ the last week was very interesting.
Yep.
Would not have expected that.
Well, it's sort of somewhere for them to hide, like a flock to safety, but not really safety, a flock to the big names. So NASDAQ did hold up better. It was only down about 1.5%. Investors rotated into that to kind of wait out the volatility. It looks like small cap Russell 2000 stocks got hit the hardest, still about 3%. And then, bonds sold off too, which pushed the yields higher.
Yeah. Energy stocks were in the green. Gold, despite, again, sometimes things don't react exactly how you think they will. Despite all the anxiety, actually finished with a small loss, which was very surprising.
And we actually talked about gold, like just internally here.
Oh, yeah.
Like we've been talking about it for weeks now, about the way that it's acting.
We've had an overweight to gold going back to 2023, and obviously it has performed very well, but it doesn't always behave the way the story or the headlines would suggest. Sometimes it trades on rate, sometimes the dollar strength, sometimes positioning. It does not just trade on fear. And it's very interesting to see that dynamic, but still holding in an overall bullish trend for sure.
Yeah, we talk about volatility, the VIX index, the market's sort of fear gauge. It did come down a bit. It dipped below 30, still kind of sitting around 25. Normal is going to be closer to 15 or 20. So it's elevated, but not really panic levels. So we can kind of get into a few reasons why it might be elevated when we talk about kind of 5 things that people need to know. These are kind of the things that we've watched over the past week. We'll kind of get into that now, I guess. Let's talk about the Middle East conflict. The Israel struck Iran's South Pars gas field. It's the single largest natural gas reserve in the world. Iran responded. We've moved beyond kind of shipping disruptions, and now we're seeing damage to actual facilities. So that's an interesting conversation to have about what are the downstream effects of that, both in a shorter term and longer term scenario. I know you have your thoughts on that.
Yes, absolutely. It's very interesting because while if we zoom out, which is what we talked a little bit today before the show, and we think about the impact on any oil infrastructure. So let's look at the two scenarios of infrastructure being degraded and the impacts of that in scenario where the infrastructure is being improved. Okay. So with Venezuela, which sits on the largest oil reserves on planet Earth, and I may be wrong, but I want to think that it is equal to or in excess of all of the Gulf Arab states combined, significant, but their infrastructure is lacking. Now it is beginning to get brought online. The oil deliveries have, I believe, doubled in the last month, on pace to tripling this month. So that is a slow process that's going to take time and investment. Now we look at what's happened with the Russian oil and gas infrastructure as the Ukrainian armed forces have, I will say devastated. It is very underreported, but it is a significant escalation in the war where they have essentially struck everything from storage, refining, and pipelines all across the Russian oil infrastructure, that whole supply chain. That's going to take a long time to repair and get back online. So the same thing will be happening here with the Gulf Arab states or Iranian infrastructure that gets hit. It is not quick fixes. That is absolutely for sure. It could take months to years when everything is complete, depending on how significant the damage is.
Yeah. I was looking up your stat. It says basically there's a difference in natural gas and obviously oil. So that's the difference there. Oil, yes. Natural gas, no. On the difference between Venezuela and the Gulf states.
Yeah, natural gas, I would assume us and the Russians are probably tied for who has the largest supply. But it is significant, and there are ways the Saudis have really done a great job of if you look at their oil reserve and their figures, it's generally kind of stayed the same or gone up. What they say is recoverable underground, which is interesting because the enormous amount they've pumped out of the ground.
Yeah.
So ways of getting oil to be more recoverable increases. I'll talk about that in a second. But this means really that even a ceasefire doesn't automatically necessarily fix the supply constraints, the supply shock that is currently kind of rearing its head with the Strait of Hormuz still being closed. But oil is holding between 95 and 99. It says, in our show notes, we had put around 100. It's really holding more in the mid-90s, which is also interesting. So there's two perspectives here. Let's cover what's headline news. Headline news is, oil is more than just gas at the pump. It's an input cost for everything: manufacturing, shipping, food, utilities.
Well, I think we should the overarching theme is the headline news is meant to make you feel a certain way. That's why largely people get very emotionally reactive when they watch news, or when you referenced Yahoo Finance or something. Maybe, I don't know if you did in this conversation or before we started the show, but it's like these headlines that get sent to you that are so emotionally tinged, and so it gets your heart rate beaten. It like, oh man, what's going on? I got to find out about this. And it's almost always, that's the point of it. The point is to get you to watch and to tune in. So, this whole conversation is happening around both short-term narratives and longer-term narratives. Now, longer term, we understand that the market trends higher over time. As we said it last week, but we look at, especially when we're talking with clients and doing financial planning and looking at retirement, we like to talk about decades over days. We don't focus too much on the days. You can zoom out and you can see the gradual increase of the S&P over a long period of time. Now, on the short period of time, you will see a lot of turbulence. I mean, you'll see it. It happens quite frequently. You really you don't understand how frequently it does happen until you isolate those things, those scenarios and those environments, and look at them like all stacked together. Then it's kind of shocking. But what tends to happen is you get through it and then you don't remember it. Like, we have short-term memory for a lot of things, especially in this country, but the market is one of them where we tend not to remember unless it's something big. Like, what's the biggest thing that people that are coming to us or clients that we have, what's the big thing? I'll ask you the question because I have the answer and I want to see if ours is the same answer. But what's the biggest thing that people say when they come to you that they're concerned about? When they talk about concerns of the market, what's the example they bring up? Let's play some Jeopardy music.
Oh, I'm going to try to answer, not trying to guess your answer.
It's just a simple, it's a period of time in the market history that somebody that's getting close to retirement would have been
2008.
2008. That's exactly right. Yes. That's the biggest
What is
thing.
the great financial crisis?
Yeah.
I'll take
that's
200.
That's the big metric for people because it was a huge swing.
Yeah.
And, obviously those swings have not happened very frequently since 2008, but there are, half of that. The market was down 25% in 2022. So, I mean, it does tend to happen, but people tend to have a short-term memory. But the whole thing, why I interrupted you, was that this is the goal of the headline news. Yeah. And you have to be able to read beyond that.
Yeah, and there are truths to both the short-term outlook and the long-term reality. There's always layers of truth in it. For instance, with the conversation around the oil shock and a lot of the headline news that's going on, it's not technically wrong. Now, as it gets to whether or not it is inflationary is something that is interesting because you have really two schools of thought. You have that when oil prices go up, those costs flow through the economy over, say, the next 90 days, 3 to 6 months. And ergo, price of everything gets more expensive. It becomes inflationary. And when the term, the price of the object went up, not necessarily is the money supply increasing or is the dollar being devalued, but the price of the products went up. Does that feed through to the inflation metrics? Now, there's another school of thought, which has a little bit more of a historical grounding, and that is simply with commodities such as oil, when you have very quick price spikes, you have demand destruction, and the demand never recovers. So
explain what you mean by demand destruction.
So demand destruction happens when the price goes up and people use less, and that using less becomes structural. They do not change back to using more. It's not temporary. And this is backed up historically. If we go back to the Arab oil embargo, it was demand destruction. People bought smaller, more affordable, fuel-efficient cars. You saw the goodbye to the big American gas-guzzling vehicles and hello to Toyota and Honda. Governments around the world lowered speed limits to 55 miles an hour, which is still some of the max speed limits for state highways in some states. The oil use per person, per GDP unit dropped. The 79-80, the second oil shock with the Iran 1.0, the Iranian Revolution and the Iraqi war, even more efficiency. We had different fuel switches for electricity. We had more efficient homes, better insulation. 2008, when the price went to $147 a barrel that we still have not broke, made permanent changes to people's oil demand, even the COVID crash. Every single one of these instances, you have seen the structural demand for oil get crushed and it has never recovered. And so now we're at a place where that elastic relationship between supply and demand and what happens when prices goes up has a much quicker response mechanism through the electrification of transportation. 1/3 of all vehicles sold today in the world are electric. 1/3. In China, it's 60%. In the U.S., it's 20%. These are expected to grow.
These are strictly electric vehicles, not hybrid.
These are not hybrids. This is not before you even calculate hybrids. So 1 out of every 3 new vehicles sold today in the world is electric. So when price goes up, that accelerates. And that creates a permanent structural change in the demand for oil. Before the crisis started, February 27th, JP Morgan's global research put out their outlook for oil in 2026. They discounted for conflict. The conflict didn't start until the next day, February 28th. And they said they said that regardless of short-term disruption, we see the price of oil basically anchored at $60 a barrel for West Texas crude. And the IEA, the International Energy Agency, put out a report today that when we're talking about the Yahoo News, the Yahoo headline was the IEA says that the Iran conflict.
IAEA, right? Something like that.
Well, you add the other one and it's the atomic. This is, yeah.
Well,
so the headline on Yahoo was that the Iran conflict is the greatest shock to global energy in history, per the IEA. Okay, well, I read the report before I even read the headline. The report does say that, but the point of it saying it is that even though it is, they expect the global oil consumption to decrease and global supply to increase from last year. So even with this, they're already telling you we've already reached peak oil consumption. So all that being said, short term, yes, prices will be affected. When it comes to interpreting that as a long-term inflationary structural issue, you can look at the data and you come away with a much different conclusion that even when considering the largest global energy supply crisis in history, there will still be more oil produced than is used from non-OPEC countries too.
Yeah, well, if we pivot to that, because the energy, the inflation conversation is not necessarily just about energy. That's where it kind of resides today. But if we pivot, we did get a PPI, producer price index reading that came in hot for February. And that's before the data for oil started surging. So year over year, we're at like 3.4%. Why does that PPI matter?
Well, the PPI matters, and this really gets into the true inflation debate when you take out the volatile energy and gas. This gets into the really debate between the hawks and the doves at the Federal Reserve, because the PPI measures.
We'll talk about next.
Oh, look at that! I'm predicting.
This is like going.
It's going perfectly.
Going on and on.
The PPI measures what businesses pay to produce things before they sell them to you. Just think of it like the cost of ingredients before. Of the meal before it hits your plate at the dinner table. The CPI ends up being the price you pay for the actual dinner. So when ingredient cost goes up, menu prices usually follow. So PPI can be viewed as an early warning signal. Now, there are seasonal elements to PPI. There are things that could be signaling maybe stronger economic growth that could be driving that, structural changes. So it's more or less something to monitor as a trend. But it doesn't always necessarily relate directly to CPI, even though historically you can back up and you can look at trends, but short-term moves don't always translate. For instance, what's in the favor of the CPI going down is the way that housing prices and housing inflation is measured is falling like a rock, and it's a big component. So if the component of CPI that contains housing is falling like a rock, but your groceries go up 5%, you still could print a 1% inflation on the CPI. So it doesn't always mean the PPI up, ergo CPI will be up. Otherwise, we would just go by the PPI and not even have the other acronym.
Well, the other thing that's important is that the inflation that is coming from that reading is not coming from oil, because it was pre that. It's coming from services. So you got business services, you've got insurance, you've got financial costs, not just energy. Service inflation tends to be stickier because it's tied to wages and labor. So it's a little bit harder to bring down more quickly.
Yeah. That's true. Just the home insurance. Mine went up. I think you just said yours went up. Home insurance has been something, but I wonder how much of that is kind of a lagged effect from the increase of material supplies that have kind of leveled out now. And it's like the insurance companies are starting to catch up with the fact, it cost an extra $250,000 to build your house, which means that if it gets burned down, I have to pay you an extra $250,000. So they're kind of catching up to that. I know in my area, the biggest impact is the fact that there was a series of tornadoes that took place in 2023, and now it has made the rates go up.
Well, I think it's also
a lot.
I think it's also things to do with the state, because you had a lot of insurance companies. We're in Georgia. They pull out of Georgia specifically in different lines of insurance. So whether it's homeowners or auto insurance or, like an umbrella policy they pulled out, or a commercial liability policy. My wife had a commercial policy for a business that she owns, and they're not going to cover that service in Georgia anymore. I think it had to do with some of the states. So some of the states are stepping in and putting in these regulations or whatever that the insurance companies don't necessarily want to abide by. So rather than raising the cost, they just exit the market. And so I think that when you have fewer participants in the market, the other guys that are staying can say, hey, why not raise it? So, I mean, it got two things could be true. Both of those could have an equal weighting.
Now, car insurance is interesting because for the first time ever, and I mean ever, my car insurance actually went down significantly, 25%.
I don't think mine has gone down. I need to check. But, the interesting thing about car insurance coupling with the electronification, I'll use your word, of vehicles.
Electrification.
And specifically the vehicles that have self-driving or autonomous capabilities like Tesla. You have insurance companies, I think Lemonade is the one actually that's integrating with Tesla, that the more you use full self-driving, which is the feature of the vehicle that will drive you places. A lot of people says that car doesn't drive itself. I see that all the time. It does. I can assure you. I do it every day. They will actually look at how much you use the full self-driving, and they will prorate your insurance based on that amount. So they're actually using the technology to sort of supplement the cost of insurance that you're only paying for literally the times that you drive. And because they can track all of that data through the vehicle, they know all of that data. So if you get in and drive from here to McDonald's and you can control the steering wheel, you may pay a different rate for that if you just get in the car and hit the button and it drives you to the drive-through and takes you through.
It's 50% less for each mile driven. So if your insurance is $200 a month and you use your FSD, your full self-driving, it's now $100. And that is probably going to accelerate because, yes, while it is not perfection now, and that's relative, because when I say, because we both use full self-driving, its limitations are purely based upon point to point, meaning that if you're getting to, let's say, a business and the parking lot is maybe they have parking across the street, or it's parking around back at an angle that is opposite to the way you're coming in, you have some issues with that you need to take over because I have to redirect to park. Or if you're in a very rural area, you have issues.
I wonder if it would figure it out, though, because it's using vision. This is a whole separate conversation, and this really comes into play with like Rivian is becoming a more well-known player now with their autonomy and the fact that they're relying heavily on LiDAR and sensors that Tesla has sort of already experimented with and kind of changed. But Tesla is just driving with a vision. I mean, it's looking just like you are. So the question is, would it have come to the same, and I'm sure there's YouTube videos out there of people navigating parking lots and letting it just do its own thing. Would it have come to the same conclusion that you ultimately will, but maybe it just takes it a little bit longer because it's like evaluating the scenarios?
Generally, I have done that and it's been fine. Sometimes I'll just, take it over at the end. Like my driveway is a great example because I live in a more rural area. And so I pin the driveway as home. My driveway is a little longer than a quarter mile off the road. So you obviously have to go through the woods and everything. It will
over the river and through the woods.
Yes, technically, yes.
Grandmother's house.
More of a creek, but yes. So initially it couldn't figure out the driveway last year. Then it figured it out. And now it understands that when you turn in, you take a left, you go to the gate, you wait, it opens, you go down the driveway, you don't go around the loop, you go to the right, then you go into the garage. So it does figure it out. The new chips are going to be much more powerful. But all that aside, these are like tiny, like this is like 2% of your driving experience. When you think of just the simple fact that I can leave my driveway, hit the button, go into Atlanta through 16 lanes of traffic, into Midtown, into a parking garage, and it parks, and my hands have done nothing the entire time. It's full self-driving. It absolutely is. And until you experience it, it's hard to really grasp the implications, which is why you have companies like Rivian and Ford and others. They're trying to get there, and they will. There will be a broadening out other from just one brand that is doing it. But it is definitely a game changer. And the moment they crack the code with the like Waymo is doing with the cyber cabs with Tesla, and then Waymo is doing it. Once that gets cracked and the regulators approve it, you're going to see even a greater substantial drop of gas burning vehicles in the cities. It will be substantial.
And Uber announced a partnership with Rivian. Again, we're getting kind of off track, but
what were we talking about?
Interesting dynamic.
Oh, the cost of insurance. Yeah. So, when we talk about the concept of demand destruction as it pertains to oil, you can extrapolate that out to other things as well. And technology solves problems. We've seen this in real time with artificial intelligence. We've seen it coming through the COVID era as well. Innovation and technology truly solves problems. And when there is any type of crisis, big or small, that occurs, technology solves it quicker and quicker as the years go by. And so when you're looking at insurance rates, the innovation in automobiles is bringing down the cost of insurance. Even though inflation has gone up over the last 5 years, you're seeing that the price come down. Interesting to see. I don't know how that would translate into home ownership and housing, how you could bring down insurance rates as far as that's concerned. I have no idea.
Well, they would be similar to the idea of you generally get a discount on your homeowner's insurance if you have some sort of security system. So if you extrapolate that into other mechanisms that might enable smart home
fire suppression,
that's
things of that nature,
like automated systems or something like that. I could see that happening.
Automated water shut-off for flooding.
I think it would be, which I think they actually have that now. I mean, you can get water sensors that will trigger. Like you can put them down low. But yeah, I mean, that's probably going to be a steeper hill to climb than the vehicles because we're already experiencing that. But I mean, if we pivot this conversation into the inflation and, potential problem for the Fed, do we have a problem with the Fed? Will the Fed still cut interest rates in 2026? The conversation around that is nuanced.
Yeah, most recently they held steady at between 3.5 to 3.75. Kind of the headline story that's running around what Chair Powell said, that there was actually some discussion. Now, we don't have many details. The minutes won't be released until, 3 weeks from now. We won't have many details on the rate hike that was discussed, but he did reiterate that's not the base case. So there was obviously someone in the meeting that did discuss it. And so that the fact that it was on the table or discussed at all did have markets a little bit on edge. So that's kind of the lead story coming out of that meeting.
Yeah, so at the start of this year, I think markets were expecting 2 rate cuts in 2026. Now there's an argument to be made. Again, we have to distinguish between the fact that we are talking about a moment in time, which we are at right now, and a moment 2 months down the road where we will be in a different regime with the Federal Reserve. The Federal Reserve Chairman, Jay Powell,
40 days.
40 days. All right, his term ends. He will be replaced. So all of the conversation that you're hearing in the news and the headlines about the Federal Reserve, about what they will and won't do, should be interpreted under the guise that the current leadership will be different. Now, the board will be still made up of the same people, largely. The head of that, it is democratized, so to speak. They vote on it. They figure out what's going on, but there will be a different head of the Federal Reserve. And so does what he has talked about, which is lowering interest rate, does that mandate come, does it take on more of a immediate, I don't even know what I'm trying to say. Does it become more important for the rate cuts at that point when he gets in and has kind of a different idea of how he wants to do something?
Yeah, I think so, because what you're going to see is the third, I think it will be the third Fed Treasury Accord, where throughout the last 100 years, there's been 2 instances. This will probably be the third. There may have been more than 2, but I think 2 notable instances of the Fed and the Treasury coordinating for kind of a reset on the rate curve and a reset of policy. From my understanding, and obviously you can only go off what you hear and listening to interviews and reading commentary from the individuals that we're speaking about, the new, who will be, we think, the new Fed chair. He's a big believer in using interest rate policy to achieve the mandate rather than the balance sheet. And he's also a big believer that the Fed must be attentive to productivity gains and understand that productivity gains in the economy give you room to cut to get the cost of borrowing down for the consumer. So it's going to be very interesting to see how that plays out. But yes, I do think,
and for the government.
And for the government as well. So I think that if you had to place a bet, you would place a bet on the dot plot getting completely redone in April. Completely.
Yeah, that'll be interesting to see.
Yeah. Now we're talking, a lot of the work's already been done. We have to, and I say give credit. It's not really like a credit, but you have to acknowledge what has occurred. I mean, there's been a lot of rate cuts from the peak already. So we're kind of getting close to that landing. How close can we get to 2%? And we're at 3.5%. Most likely that happens sooner rather than later. But nobody knows. That's why I believe that it is not Bill Ackman. I believe it is Stan Druckenmiller that said that if you could predict the movement of interest rates 7 times correctly, you can turn 10,000 into $1 billion. So it's very hard to do. There are lots of things that occur, but the trajectory, when you go out long term, the trajectory is definitely on the downward trend, which will be great for consumers, great for people looking to buy a home, to refinance their home. It is going to be a long-waited, happy time for the refinance market.
Lower savings rates, lower treasury yields, that sort of thing.
Yeah.
At least on the short end.
Yeah, on the short end. And then borrowing will get less expensive as it pertains to businesses and car loans. But we are kind of nearing the end of the era of your savings account paying you something meaningful, which I think
we've been in it for a while.
But even if we settle it with innovation now, and we talk to clients a lot about helping them get out of these savings accounts that are paying 0.001%, even with rates settling, say around 2.5%, you still want to be kind of, if you have an emergency fund, you want to be very proactive in figuring out, okay, well, can I get 2 or 3 points on it?
Is this?
Because it's better than 0.00001. I mean, it's so crazy to see a savings account, a client bringing a savings account, say 100, 150 grand, and it's like the interest they earned was like 7 pennies.
Yeah.
Yeah,
it's unfortunate.
So there'll still be that delta, that gap between your big banks and then what the actual interest rates are. Even if they're 2%, it still will be a much better deal.
Yeah, I mean, I think that's right. Let's kind of go on here. The market kind of being choppy. Should we be worried about investments right now? This is kind of where I want to spend a little bit of time because I think a lot of people are here emotionally. So the market itself has had this pattern for weeks of kind of rally on good news, sort of sell off on bad news, or when the reality kind of reasserts itself. That back and forth can be psychologically exhausting. Every time you open your account, it's a different number. It's up, it's down, it's up, it's down. That inconsistency kind of naturally you want to do something about that. It makes you want to do something. Makes you want to take an action. Doesn't matter what it is. Just you gotta feel like you're taking an action.
Yeah, that's what hurts people. What hurts people is reacting to a short-term change and ending up with long-term consequences. The analogy I have always used is that we know our home prices fluctuate from year to year. And we also know that our home value appreciates over a long period of time. So if you buy your home for $300,000 in 2020 and you're going to live in it for 20 years, you already know you're going to be able to sell it for more than $300,000. You know that your home prices are going to go up because you have lived that experience. You have seen it. It's a tactile experience. You buy the home, you touch it, you understand that it's going to go up, and you're fine with paying the mortgage rate that you're paying and the interest that you're paying because you understand that it is over time going to build equity and have a return on your investment.
Right.
Now, if you got a report every day, an official
Some
report,
people do. Not official, but
yeah, or every month you got a statement from the mortgage company that had red or green on it and told you that month's value of your home, when you get the report and next month it says that you're down 5%, you bought your home for $500,000, now it's only worth $475,000, would that make you immediately pack up all your belongings and sell the home?
Well, I think that's why people, the appraisals, and that's a whole separate conversation about appraisals, but that's why values you don't tend to get those until an appraisal. So most people just don't even pay attention to it, which is the greater point here, which is what you should do. But we don't ever want to we want to validate the discomfort. So we don't ever want to discount that. And we do that same thing with clients when we have calls and phone calls about people who are nervous or who are seeing big market swings or hearing things in the news. That uncertainty is real. It's okay to feel that way. But what we don't want to let you do is let that cause you to make financial decisions based on that. That's the conversation that we want to have. And that's the value of having somebody on your side that can sort of be a sounding board there for, here's what I'm thinking. Here are my fears. Here are my concerns. Kind of talk me through that. And that's really a large part of any financial advisor's jobs.
Yeah.
Only ours.
No, it is. They are valid. It is valid because it is the system that we live in. sometimes the things that you don't understand or think are illogical are actually what matter. They in the long term are the most beneficial to you. So, we were raised, especially, well, not us, but, I'll go to my parents who were, especially my dad, who was much, much, much older than I was, and older than most. The age gap was pretty significant. My grandmother was born in 1917. So the generation that went through the Great Depression had a much different mindset. You don't trust Wall Street, you don't trust banks. That filters down into their children. And it creates this long distrust, even though as the economy evolves and things change and no two crises are alike, it still has that underpinning discomfort. So it can seem illogical to say, well, I'm going to invest in my 401k, and then you see a month or a year where it's down in value. You say, well, why am I throwing good money after bad? But a year after that, you look back and you say, oh my God, I'm up 50 grand, right? And then 3 or 4 more years go by and you understand how the process works. These are just temporary price movements that are determined based on the last person to sell that stock and the last person to buy it. That's all that the price determines. When you look at a share of Apple today, and when the market closes, that price is literally representative of just the last buyer and the last seller coming to an agreement. That's it. But we know the long-term trajectory is because of their productivity and the amount of money that they're making, that the value is going to go up over time. So you have to ask questions. And when you have concerns, you need to bring them up to your financial advisor and talk through it so you can get a good understanding. But always think about that analogy with the house, because we know house prices fluctuate. Everybody has lived through periods where your house has gone down in value relative to what you paid for it. But you also know over a long period of time, you're going to be able to sell it for more than it's worth. And so if your mortgage statement tracked the value of your home and you saw that in 2023, that it was down by 5%, you wouldn't pack all your bags up and sell your house and take a loss, because you would know in 2026, I'm going to be able to sell this for much, much more. I mean, my God, it happened during COVID. It happened during, I sold one house plus 2 other family members' houses. And, it was necessary to sell them at the time that we did. But my God, if I'd have waited 12 months, I mean, insane, right?
Yeah.
So you have to broaden your understanding of why you're invested, why you cannot save in dollars. You just simply can't. It will go down in value over time. You have to take and trade those dollars for assets, for things that go up in value. And that's what we do when we invest in our 401k and in our IRA accounts, our retirement accounts. We're taking our dollars and we're getting rid of them. We no longer have them. We are acquiring assets, stocks, bonds, commodities that have intrinsic value, that have growth potential. We no longer have the money. So when you look at your statement and you see that it's down from 500,000 to say 480, that's not dollars. That's the value of your assets. Just like in your home, it's priced in dollars, but it's not dollars. It's the value of your home. And you have to have patience and you have to have perspective to know that what is guaranteed in life is the value of that dollar is going down. And what is guaranteed is that the value of assets priced in dollars are going to go up.
Yeah. I mean, you still want to make sure you have your short-term needs covered.
Oh, cash and diversification.
So you don't have to sell to kind of do that.
That's your emergency fund. That's your cash cushion in your brokerage account. That's, yes, because you will have to liquidate assets to get dollars to pay your taxes, to buy your groceries, to buy your $200 steaks. Apparently, have you looked at the price of steaks lately?
I have not. You have, I'm assuming.
I'm eating less red meat, but I did look the other day. Yes, I did. My aunt asked if she wanted a steak. I was like, okay, I need to get some steaks. It's been a while. I was like, whoa.
Yeah.
We eat a lot of chicken.
I think everybody eats a lot of chicken. We eat a lot of chicken restaurants around here.
A lot of chicken.
Well, let's get into the financial planning topic. Let's wrap up there. I know we're going long on this one, so I don't want to beat a dead horse, but we had a couple of things come up this week with client situations. So what is specifically, we had a couple of items come up. So the first one was kind of a sort of a mix up with a tax preparer. So tell me about that.
Yes, very, very important when you are filing your taxes. If you have had a rollover, a direct or an indirect rollover, to always encourage and push your tax preparer to understand that that money went from point A, your old retirement account, to point B, your new retirement account. Because we've run into a couple scenarios where the rollovers were not coded correctly at the tax preparer level, and it created a tax bill that was due. So we're in the process of helping clients correct 2 of those with their tax preparers because it wasn't entered correctly. And sometimes the forms that the custodians send, they can be confusing. And so if they're not used to seeing rollover forms or indirect rollover forms, the taxpayer really may not be well equipped either from the system they're using or the experience they have to really code it correctly. And that can cost you a lot of money. So if you've had a rollover go through, just make sure you're triple checking that it is no tax implications on your tax forms. And if you have a question, reach out to us, momentumwealth.us. We'd be more than happy to talk about your current situation to see what was done and the advice that we would give to save you those tax dollars.
You also want to verify that before the taxes are filed.
Correct. It's always helpful if you see that
it can be undone, but you always want to catch it beforehand.
Yeah, if you see you owe taxes, hit the pause button, and let's revisit and see what's actually going on, because we've done thousands of rollover transactions, and we know exactly what they should look like, how they should be filed, and so we can guide you directly on what's going on. And and conversions too, the way conversions need to be coded.
Yeah. So the second thing we had was we've actually gotten this a couple times over the past few weeks. Self-employed, like contractors, 1099s, or if you have an LLC and you get a W-2, if you're an S-corp or something like that. What options are out there for you to lower your taxable income and also contribute to a retirement account?
Yeah. So another wonderful thing that we do for clients is paying very close attention to tax efficient investing. And there are a few different ways to go about that. When it comes to being a 1099, being a self-employed person, you have some tremendous tools at your disposal to tax shelter your profits, your excess earnings, more than what is your wage income. Most recently, we've helped a couple clients with 401k solo plans. So if you have an LLC and you have around about $100,000 of income, generally speaking, in consultation with your CPA, we can advise the establishment of an S-corp away from a C-corp, which is what your LLC is running on now, and split that income between a wage and a draw. That saves you self-employment taxes on the draw, 14% of the FICA taxes saved on the draw, and it allows you to take your wage and divert that into a 401k solo plan, which can be really great if there's other sources of income that are coming in. So let's say that your spouse has a job and is working, and you obviously have to have the extra money. You can't spend everything that you're making because you have to have something to invest. But if you have income that's coming in that you do have money freed up in your budget, and you just don't want to be forced to buy a piece of equipment or just pay taxes and have it in the savings account, 401k solo plans are a great tool along with SEP IRAs. So tax efficient investing is something that really needs to be brought back to the forefront of people's minds, because it is a powerful tool. It gives you the ability to endure volatility in the market because you're saving 30 cents on every dollar that you put into it. So you already have you're going to give, let's use $100,000 as an example. If you put $100,000 into the 401k solo versus not, you're saving $30,000 in taxes, basically, in this example, this hypothetical that I'm giving. So you are already going to give away $30,000 to the government. So psychologically, it can help you to get that money into the market, knowing you have a pretty wide risk tolerance level because you had $30,000 that's just free money, essentially, as you were already going to be paying it to the government. So that really helps not worry about the timing issue, or is now a good time to get in the market? Doesn't really matter. Let's get you in there. Let's get you tax deferred. And then consistently year after year, you really don't have to worry about the timing aspect of it.
Yeah. So the two there that you're looking at are really SEP IRA, solo 401k. Solo 401k is going to give you that Roth option. It's going to be after tax contributions. So it's just, your situation is going to be unique to you. It needs to be done with, needs to be looked at with the assistance of a financial advisor or a CPA, somebody you can kind of volley back and forth on. But those are very good tools to use for sure.
Yeah, absolutely. always reach out to us. Again, I can't underscore the importance of having a free conversation with a trusted advisor. We're able to take and aggregate the thousands upon thousands of interactions that we've had with clients and convert that into and distill that into usable data for you so that you don't have to worry about trying to go through and learn lessons the hard way, because essentially we've learned them for you through the experience of so many other people that we've helped and interacted with.
Yep.
And it's a powerful tool, and it's a great, and there's really no age that it's not a good idea. If you're a contractor and you're 1099, there's no age to where it doesn't make sense to do. In fact, the argument can be made that if you're over 59 and a half, it's even a better deal.
Yeah, there's nuance there, and there's variables that are going to change based on your age. But yeah, the larger point is accurate. I think that's a wrap. We're over this week for sure, so I don't want to keep anybody beyond that. But yeah, thanks for joining us on this week's Good Returns. That weekly note will be in your inbox to kind of go over that. If you're a client, if you're not a client, you can certainly get on that list. Check us out at momentumwealth.us. Like, share, comment. Tell us in the comments, are you concerned? Are you looking at market volatility as kind of a thing that you're scared of, or are you looking at it as an opportunity? Be interested to know.
Yeah, absolutely. It's been great. It's been a great week. We'll be back next week. Lots probably going to happen between now and then. So
I can guarantee
we never have a shortage of content to talk about. So we greatly appreciate everyone taking the time to listen. And as always, enjoy your weekend and take care.
See you next week.